The Little Book That Beats the Market, by Joel Greenblatt. Introduction. There's a story I want to tell you, and it starts in the most unlikely of places. A school hallway, with a sixth grader who's making a fortune. His name is Jason. He doesn't have a fancy office or a business degree. His entire enterprise fits into his backpack. Every morning, he buys a few packs of gum for 25 cents each. Each pack has 5 sticks. Once he's in school, he becomes, in his own way, a superhero of commerce. He sells each individual stick of gum for 25 cents. Now, you and I can do the math on that. A 25-cent investment turns into $1.25. That's $1 of pure profit on every single pack. And he does this day in and day out. It's a simple business, but it's brilliant. It's profitable. And in this very simple story lies a profound secret. A secret that has made fortunes for some of the world's greatest investors, yet it remains just out of reach for most people. What if I told you that by the end of our time together today, you will understand this secret so deeply that you'll see the entire stock market in a new light? What if I told you there's a magic formula, a simple, logical method that can teach you how to consistently buy good companies at bargain prices, and do it with less risk than most people take when they invest? This is the promise of a remarkable little book by a man named Joel Greenblatt, an investor and professor who has not only achieved legendary returns himself but has dedicated himself to simplifying the complex world of finance so that anyone, even his own children, could understand it. The book is called The Little Book That Beats the Market, and it's sold millions of copies for one simple reason: it delivers on its promise. Greenblatt's journey wasn't about creating some dense, academic textbook. It began as a gift for his 5 kids. He wanted to give them something that would keep on giving, the knowledge of how to make money for themselves. And he figured if he could explain these powerful concepts in terms simple enough for a middle schooler to grasp, then he could teach anyone. So today, we're going to walk through his story. We're going to unravel this magic formula. But more importantly, we're going to build, step by step, a new way of thinking. A way of thinking that cuts through the noise, the fear, and the complexity that stops so many people from succeeding. This isn't just about numbers, it's about a philosophy. And the first lesson begins with that young man in the hallway, selling sticks of gum. Book summary. Imagine you're watching Jason, the gum-selling prodigy, and you realize he's got a fantastic business. Let's say he's making about $3 a day in pure profit. Over a school year, that adds up to over $500. And he has 6 more years until he graduates. That's a future profit of around $3,000. Now, suppose Jason comes to you with an offer. He says, "I'll sell you half of my business. You get half of all my profits from now until I graduate. But you have to pay me for it now." How much would you pay? Your half of the future profits is $1,500. Would you pay him $1,500 today to get that same amount back over the next 6 years? Of course not. That doesn't make any sense. You're not getting any return, and you're giving him your money up front. There's risk involved. Maybe he gets sick. Maybe the school bans gum sales. Maybe another kid starts competing with him. But what if he offered you half the business for just $1? You'd take that deal in a heartbeat. It's a guaranteed win. So the right price is somewhere between $1 and $1,500. This simple exercise, thinking about what a business is truly worth versus what you can buy it for, is the absolute foundation of successful investing. It's not about charts or trends or what the news is screaming about. It's about one thing: figuring out what a business is worth and then paying a lot less for it. Most people think this is impossible. If a business is worth $1,000, why would anyone on earth sell it to you for $500? It sounds too easy, too good to be true. And yet, there is a place where this happens every single day. A place where $1,000 bills are regularly sold for $500. That place is called the stock market. To understand how this is possible, we need to meet a friend. He's a character invented by one of the greatest investors who ever lived, Benjamin Graham. His name is Mr. Market. Imagine you own a small piece of a great business, and you have a partner, Mr. Market. The problem is, your partner is a manic depressive. He has wild, unpredictable mood swings. Every single day, he comes to your door and names a price. He offers to either buy your share of the business or sell you his share at that exact price. Some days, he's euphoric. He's bursting with optimism and sees nothing but a golden future. On those days, he offers you a ridiculously high price for your share, a price far more than the business is actually worth. A wise person would happily sell their share to him on those days. But on other days, he's terrified. He's panicked and sees only doom and gloom. He's convinced the business is on the verge of collapse. On those days, he comes to your door and offers to sell you his share for a ridiculously low price, pennies on the dollar. On those days, if you know the true value of the business, you would leap at the chance to buy his share from him at such a bargain. And on some days, his price is neither high nor low. It's just fair. On those days, you do nothing. You simply ignore him and go about your day. The most important thing about your partner, Mr. Market, is that he never forces you to do anything. He is your servant, not your master. You are free to ignore him completely. You only have to engage with him when his emotional state creates an incredible opportunity for you. This, Joel Greenblatt tells us, is exactly what the stock market is. It is Mr. Market. Every day, the news, the experts, the flashing numbers, they are all just Mr. Market, yelling prices at you. One day, a company like General Motors is worth $60 billion according to the market. A few months later, the same company, with the same factories and the same workers, is suddenly worth only $30 billion. Did the fundamental value of one of the world's largest car makers really get cut in half in a matter of months? Almost certainly not. What changed was Mr. Market's mood. The secret isn't to predict Mr. Market's mood swings. That's impossible. The secret is to know the real value of the business, independent of his mood, and to act only when he offers you a true bargain. This principle is what Benjamin Graham called the margin of safety. If you've calculated that a business is worth $10 a share, you don't buy it at $9.50. You wait until Mr. Market is in a panic and offers it to you for $5 or $6. That huge gap between the real value and the price you pay is your margin of safety. It's your cushion against being wrong, against bad luck, against an uncertain future. At this point, you're probably thinking what every one of Greenblatt's business school students thinks: this sounds great. But how on earth do I figure out what a business is really worth? Aren't there thousands of brilliant professionals with PhDs trying to do this exact same thing? What chance do I have? This is where the fear creeps in. This is where most people give up and decide it's all just too complicated. And this is where Greenblatt introduces a lesson that's as simple and profound as the wax-on, wax-off training in The Karate Kid. In the movie, the young student Daniel wants to learn karate to defend himself. But his master, Mr. Miyagi, doesn't teach him punches and kicks. He makes him do chores, waxing cars, painting fences, sanding floors. Daniel gets frustrated. He feels like he's wasting his time on menial tasks. But then, Mr. Miyagi starts throwing punches at him. Wax on, wax off, he yells, and Daniel's arm instinctively blocks the punch with the circular motion he learned from waxing cars. The fence painting motion blocks another attack. The floor sanding motion blocks a kick. Without even realizing it, Daniel had mastered the fundamental movements of defense. He had become a karate master by focusing on a few simple, powerful principles. Greenblatt says that investing is the same. You don't need to be a genius. You don't need complex formulas or a deep understanding of the economy. You just need to master two simple concepts. Two wax-on, wax-off principles that, when combined, give you all the defense you need to succeed. So, what are they? The first concept is about finding bargain prices. Think back to Jason's gum business. He was offering a share for $12, and last year that share earned $1.20 in profit. The profit divided by the price gives you what's called an earnings yield. In this case, $1.20 divided by $12 is 10%. Now, imagine another company. It also has a share price of $12, but last year it earned $2.40 per share. Its earnings yield is 20%. A third company, also priced at $12 a share, earned $3.60. Its earnings yield is 30%. Here is the million-dollar question. All other things being equal, which company would you rather own? The one with the 10% yield, the 20% yield, or the 30% yield? The answer is obvious. You want the highest earnings yield possible. You want to get the most earnings for the price you pay. That's it. That's wax on. It's a simple way to measure if a business is cheap. We want a high earnings yield. The second concept is about finding good businesses. Price is only half the equation. A cheap business can still be a terrible investment if the business itself is bad. So, how do we define a good business in a simple way? Let's go back to Jason. To open one of his gum stores, let's say it costs him $400,000 for the location, the inventory, everything. And last year, that one store generated $200,000 in profit. That means for every dollar he invested in his business, he got a 50-cent return in a single year. This is called return on capital. A 50% return on capital is phenomenal. It tells you this is a very, very good business. Now, let's look at his friend, Jimbo. Jimbo owns a chain of stores called Just Broccoli. It also cost Jimbo $400,000 to open a new store. But last year, each of his broccoli stores only made $10,000 in profit. His return on capital is a measly 2.5%. Another tough question for you. Which business would you rather own? Jason's Gum Shops, with a 50% return on capital, or Jimbo's Just Broccoli, with a 2.5% return? Again, the answer is obvious. You want the business that can take a dollar and turn it into the most profit. You want a high return on capital. That's wax off. And that's it. Those are the two principles. 1. Find companies with a high earnings yield that are cheap. 2. Find companies with a high return on capital that are good. The magic formula, the great secret that this entire book is built around, is simply this: combine those two ideas. Systematically buy good companies, but only when they are available at bargain prices. It sounds almost insultingly simple, doesn't it? But think about what you're actually doing. By focusing on a high return on capital, you are filtering for special companies. These are businesses that likely have some advantage, a great brand, a better product, a unique position in the market, that allows them to be incredibly profitable. They are the Jason's Gum Shops of the world, not the Just Broccolis. And then, by focusing on a high earnings yield, you are waiting patiently for Mr. Market, in one of his fits of pessimism or fear, to offer you a piece of one of these wonderful businesses for far less than it's worth. You are combining quality with price. So, Greenblatt decided to test this. He went back 17 years and programmed a computer to do exactly this. He had it rank thousands of the largest companies traded in the U.S. First, it ranked them all by return on capital, from best to worst. Then, it did a separate ranking of the same companies by earnings yield, again from best to worst. Finally, it just added the two ranks together. A company that was pretty good on both metrics could end up with a better combined score than a company that was number one in quality but very expensive. The formula was looking for the best combination of good and cheap. Then, the test was simple. What would have happened if, over those 17 years, you had simply bought a basket of the top 30 highest-ranked stocks and held them for 1 year, repeating the process every year? The results were not just good. They were staggering. Over that 17-year period, the portfolio of stocks selected by the magic formula returned an average of 30.8% per year. During that same time, the overall market average returned about 12.3%. Let me put that in perspective for you. An $11,000 investment in the general market would have grown to about $79,000. Not bad at all. But that same $11,000 invested using the magic formula would have grown to over $1 million. And it would have done so while taking on less risk than the overall market. The formula didn't just work on small, obscure companies. Greenblatt tested it on the largest 1,000 companies in America, the blue-chip stocks that everyone knows. Even in that group, the formula practically doubled the market's return, averaging 22.9% per year. He then did something even more remarkable. He divided all the companies into 10 groups, from the highest ranked by the formula to the lowest ranked. And what he found was incredible. The results worked in perfect order. The top-ranked group performed the best. The second-best group came in second. The third-best came in third, all the way down to the 10th group, which contained the worst-ranked stocks, the expensive, low-quality businesses. That group performed terribly. The formula wasn't just getting lucky with a few stocks. It seemed to have an almost predictive power about which groups of stocks would do well and which would do poorly. At this point, the question becomes unavoidable, and it's the most important question in the entire book. If this formula is so simple and so powerful, why doesn't everyone just use it? And if everyone did, wouldn't the bargains disappear, ruining the formula forever? Here we arrive at the heart of investment psychology, and the true genius of Greenblatt's approach. The reason the magic formula will likely continue to work is precisely because it is so difficult to follow. Why? Because it doesn't work all the time. This is the great paradox. Looking at the data, Greenblatt found that in an average year, the magic formula portfolio would actually perform worse than the market in 5 out of 12 months. Even more, it would often underperform the market for an entire year. Sometimes, it underperformed for 2 years in a row. And there was even a period during that wildly successful 17-year run where it lagged the market for 3 consecutive years. Now, I want you to really imagine what that feels like. You've put your hard-earned money into this strategy. For 1 year, 2 years, maybe even close to 3 years, you are losing to the market. Your friends who just bought a simple index fund are doing better than you. The news is telling you that the stocks you own are dogs. You look them up and realize that many of them have scary headlines or uncertain futures. Every instinct in your body will scream at you to quit. To sell everything and just do what everyone else is doing. The human mind is not wired for this kind of long-term patience. We are creatures of social proof. We hate to feel like we're being left behind. And this psychological pressure is what makes most people abandon the strategy right before it's about to pay off. Greenblatt tells the story of another author who found a successful formula, launched a mutual fund based on it, and then watched it underperform for 2 of its first 3 years. He ended up selling his fund management company. Had he waited, he would have seen that same fund go on to become one of the top performers over the following years, its long-term record vindicating the strategy completely. But the short-term pain was too much to endure. This is the moat that protects the magic formula. It requires a level of faith and long-term perspective that most individual and even professional investors simply do not have. Professionals are under pressure to perform every quarter. If they lag for too long, their clients pull their money and they lose their jobs. So they are forced to play a short-term game, often buying popular stocks to avoid looking foolish, even if they know those stocks are overpriced. This is why Greenblatt says that believing in the formula is the most important ingredient. You don't just have to understand it intellectually, you have to believe it in your bones. You have to understand why it works, that buying good businesses at bargain prices is a timeless, logical principle that will, over the long run, win out. Mr. Market can stay irrational for a long time, but not forever. Over a 2 to 3 year period, reality tends to assert itself, and the true value of a business is eventually recognized. So, what does this all mean for you? Greenblatt is clear. For the vast majority of people, trying to pick individual stocks on their own is like running through a dynamite factory with a burning match. You may live, but you're still an idiot, unless you have the skill and time to deeply analyze a business and project its normal earnings years into the future. You shouldn't even try. For those people, he offers a few paths. One is to simply buy an index fund. You'll get the market's average return, which historically has been quite good, and you'll do better than most professionals after their fees. It's a perfectly sensible choice. But if you want to do better than average, if you want to beat the market, then the magic formula provides a clear, simple path. And he even created a free website, magicformulainvesting.com, to do all the work for you. It screens the market, runs the rankings, and spits out a list of top-ranked stocks. The instructions are straightforward. First, you build a portfolio of 20 to 30 of these stocks. But you don't buy them all at once. You buy 5 to 7 stocks every 2 or 3 months. This diversifies your entry points over time. After about a year, you'll have your full portfolio. Then, as each stock hits the 1-year mark, you sell it and replace it with a new top-ranked stock from the list. And you just keep doing this, year after year, through good times and bad. Regardless of what the market is doing, regardless of your short-term results. You commit to the process for a minimum of 3 to 5 years, because that is the time frame over which value tends to win out. The hard part isn't the buying or selling, that takes just a few minutes every few months. The hard part is the waiting. The hard part is the believing. In the end, this little book isn't really about a formula. It's about a philosophy. It's about recognizing that the stock market isn't a mysterious, complex machine. It's just a marketplace full of emotional people, driven by greed and fear. And if you can remain disciplined, if you can anchor yourself to the simple, timeless principles of value, you can turn their emotion into your opportunity. You can let Mr. Market serve you, instead of the other way around. And that, more than any formula, is the real secret to beating the market. Commentary. As we step back and look at the lessons from the little book that beats the market, what strikes me most profoundly is not the formula itself, but the deep sense of empowerment it offers. In a world that often makes investing seem like a secret club, reserved only for the financial elite, Joel Greenblatt throws the doors wide open. He tells us that the keys to the kingdom are not hidden in complex algorithms or insider knowledge. They are rooted in common sense. The most powerful lesson here is the triumph of simplicity. We live in an age of information overload, where we're told that more data, more speed, and more complexity will lead to better decisions. Greenblatt's work is a powerful counter-narrative to that idea. He proves, with decades of evidence, that 2 simple, intuitive ideas, buy good businesses, and buy them cheap, are more powerful than the vast majority of sophisticated strategies employed on Wall Street. This matters today more than ever. We are constantly bombarded with financial news, with hot tips, and with the fear of missing out on the next big thing. This noise creates a permanent state of anxiety for most investors. It pushes them into short-term thinking and emotional decision-making. The magic formula is, at its core, a system for ignoring all of that. It's a disciplined, mechanical process that forces you to act rationally when everyone around you is acting emotionally. It's a shield against your own worst instincts. But the book's second lesson is perhaps even more critical: the importance of a long-term horizon. Greenblatt repeatedly emphasizes that the strategy will go through painful periods of underperformance. This isn't a flaw in the system, it is the very reason the system works. Because if it worked every single month, everyone would do it, and the advantage would vanish. Its periodic failure is the price of its long-term success. This teaches us something fundamental about life, not just investing. Anything truly worthwhile requires patience and conviction. It requires the strength to stick with a sound strategy even when the short-term results are discouraging. Whether you're building a business, learning a new skill, or investing for your future, the path to extraordinary results is almost never a straight line. It is paved with moments of doubt, and only those who can endure them will reach the destination. So, how can you apply this today? First, change your perspective on what a stock is. Stop seeing it as a ticker symbol that bounces up and down. Start seeing it as what it truly is, a small piece of ownership in a real business. Before you ever invest $1, ask yourself the questions Greenblatt teaches us. Is this a good business? Is it available at a bargain price? This simple shift from speculating to owning will change your entire approach. Second, embrace a long-term mindset. Greenblatt suggests a minimum of 3 to 5 years, but the longer, the better. When you think in terms of years and decades, the daily noise of the market fades into irrelevance. You stop worrying about today's headlines and start focusing on the enduring value of the businesses you own. Finally, and most importantly, find a strategy that makes sense to you and stick with it. For many, the magic formula itself is an elegant and powerful solution. For others, it might be a simple index fund. The specific strategy is less important than your ability to adhere to it with discipline and patience. Find your wax on, wax off principles, the core beliefs that will anchor you, and trust them. That was a summary of The Little Book That Beats the Market by Joel Greenblatt. We've journeyed through the core ideas today, but I'll be honest with you, a summary is like looking at a photograph of a beautiful landscape. It can show you what it looks like, but it can't make you feel the sun on your face or the wind in your hair. The real magic happens when you read the book for yourself. It's in the simple, fatherly tone Greenblatt uses, the way his stories and analogies click in your mind and permanently change how you see the world of money. This summary is designed to help you decide if this book is worth your time. If anything we've discussed today has sparked your curiosity, I encourage you to grab a copy. Reading it isn't just about learning a formula, it's about gaining a philosophy that can serve you for a lifetime. Also, if you found this journey valuable, please take a moment to like this summary and subscribe to the channel. It lets me know that this work is making a difference, and it ensures you won't miss our next exploration into another life-changing book. Let's keep learning and growing together.